I'm going to start to record the session, and I'll also try to transcript it. Right. So guys, the reason for this session is for you to be prepared for the test 2, and having looked at the questions that are going to be asked in test 2, we decided to go through this question paper. And I strongly believe that it's a question paper that is going to definitely help you guys to be well prepared for the upcoming test. So we strongly believe that it's going to really help you. Right? We strongly believe that it's going to really help you. Okay. Right. So I think one of the things that I want people to follow is the kind of thinking that we want to apply when you're answering these questions. So one of the first questions that we're going to look at, we'll be focusing on the income tax of a company. So they are going to ask us to calculate the normal taxable income. I think it's very important that when they say normal taxable income, they did not necessarily say calculate the taxable, the tax to say, right? They say the normal taxable income. So when they say so, they don't necessarily want you to apply the tax rate. But if the question then asks you to calculate the normal tax, then in that case, you are supposed to be... Sorry, guys, if you can mute yourself for a question. Okay, so what I'm saying is you need to understand what the question is asking and to what extent are you supposed to go with the question. So you are not supposed to do something that is not asked. Remember, you're not going to earn any marks for something that was not asked. So let's just make sure that we are very clear. We understand what the question is asking up to. So they say no more taxable income, right? So this is for Tobiso Sports Pty Limited for the 2022 year of assessment. However, they said you must assume that the 2023 tax legislation will apply. Okay. I don't think for now we have much of a problem with what we need to do, but I think you're going to see as we go further next year, it's going to be very important that we pay attention to what will be happening because there's a lot of changes that will be coming in from next year, right? Okay, so we do have this question that wants us to calculate the normal taxable income. Then we have a separate independent question that is asking us something in terms of, they are saying, write an email to Mr. Indarasam Naidu, right? And discuss whether the amounts expended for each of the 4 transactions will be deductible in terms of the general deduction formula. Read with section 23. So remember, when you think about the general deduction formula, that's section 11A. And when you are looking at section 11A, I think it's very important that you read it together with section 23. 23. So section 23 also speaks to some of the deductions that are strictly prohibited. So it's very important that when you're discussing the general deduction formula, you also think about some of the things that are strictly prohibited by the section, right? Then from there, I think the other issue that is important, support your answer with the relevant court cases where applicable. So where you know there's a certain case law, please discuss what is the principle in that case law. And of course, you can also mention the name of the case law. But in most cases, we are more interested in the principle that is being derived from a case law, right? Then from there, I think one of the questions that we also have here, I think there's a question on capital gains. There's an issue of ethical concerns here. Advise Tobiso Sports Limited on the appropriate actions, including ethical considerations, to address these 2 suspect transactions. So they gave you a certain template to say this is how you should be looking at it. And yeah, that's how you're going to work on that. Okay, right. So that's what we're going to do. And the good part is this question paper also have some capital gains. And I think that's going to assist someone. And there's an issue of deferral of recoupments, deferral of normal capital gains. So that is going to emanate from this section of the question. So let me get straight to the first part of the question. So I think the layout is also something very, very important. So what we are going to do on this question probably, okay. So we'll be just moving around from our Excel. So we're gonna present our solution here. So we're gonna write the heading there. So maybe we can just say, let's see. Okay, so we're gonna calculate the normal tax for this entity. Right, this is for 2022. No more taxable income. So what we normally do, guys, we have a column for the taxable income, and we have another column as well that is just for some calculations. So I'm gonna have this column that I'll use for some calculations. And now we have the column for the taxable income itself, but this column I also have it for some calculations that needs to be done. Then from here, I'm going to be putting my items there. Then in these two columns, I just need to make sure that my numbers will be looking good there. Okay. So guys, when you're given a question like this, let's just quickly unpack what the scenario is talking about. But if you look at the question, what it's saying, it's Tobiso Sports Pty Limited, TS, is a resident company that manufactures sporting equipment. So I think there are two things that I need to pick there from that scenario. So we have a resident company, and they are also in the manufacturing of sport equipment. So it helps me to understand that some of the machineries that they might have, they might be used in the process of manufacture. So that's something very, very important. For a local market in Durban, South Africa, the company's manufacturing process has been approved by SARS as a qualifying process of manufacture. So I think one of the things, I think those who have read section 12 cap C, you agree with me that for you to be allowed to make a deduction in terms of section 12 cap C, the process of manufacture should be something that has been approved by SARS to say this is a process of manufacture, right? However, this business, we also need to take note of the fact that the company is not a small business corporation. So this is not a small business corporation. Maybe someone can guide us here. I just want to check if someone is willing to tell us what is the difference of having a company that is a small business corporation and a company that is not a small business corporation from a capital allowance point of view. Anyone willing to tell us your thinking there? From a capital allowance point of view, what do you think is the difference if we have another business that is considered to be a small business corporation and the other business that is not considered to be a small business corporation? What would be the difference? You can put in the chat if you don't want to unmute yourself, but you can also unmute yourself and let us know. What's your thinking there? Okay, 30 seconds, otherwise I'll take it myself. So if you didn't get the question clearly, we are just saying, what would be the difference of another business being considered to be a small business corporation and another one not being considered to be a small business corporation? What would be the difference? Guys, this is a learning platform. Don't be scared. Just feel free to let us know what you think.
I think for small business corporations, we use tax tables, and for not small business corporations, we don't use tax tables.
Okay, thanks for that. All right, cool. That's something important from a tax perspective. But I think my question was from a capital allowance perspective. So section 12 cap C is not applicable, is applicable on manufacturing or on non-manufacturing assets. Do you apply section 12 cap C when you're using, when a business is a non-manufacturing entity?
No.
Okay. What do you do? Okay, so maybe guys, to just illustrate what I wanted you to talk about, when it's a small business corporation, you then have a choice of using section what? 12 cap E, or if an asset qualifies for section 11E, you can also use section 11E, whichever is going to benefit your business, that's what you go with, right? whatever is going to give you a tax advantage. That's what you choose. Okay. But when you look at section 12 cap E, you are allowed to do 15, 30, 20. So you can claim your allowances in the ratio of 50% in the first year, 30% in the second year, 20% in the third year. However, you can also be allowed to claim a full 100%. When are you allowed to claim a full 100%? If the asset that you have acquired is used in the process of manufacture. So if it's used in the process of manufacture, you can do 100% in the year that you acquired the asset. You brought the asset into use. That is in terms of section 12 cap E. But you can also go, if it's not a manufacturing asset, an asset that is not used in the process of manufacture, you can then go with 50%, 30, 20. That's all when you're looking at the small business corporation. But it's very important that you take note of the fact that, let's say you had an asset that in terms of section 11E qualifies for 2 years. So you have an option to spread the capital allowance over 2 years or doing the 50, 30, 20. But obviously, this might be beneficial to you because you're going to have 50% in the first year, 50% in the second year. So this is likely to benefit you from a tax point of view, and you are then likely to make use of that. Guys, if you can continue to just mute ourselves, we'll appreciate that. Okay. Right, so I think I'm very clear on that discussion. If you have any question, you're more than welcome to ask. Okay. I just wanted people to understand what does that mean when we have a small business corporation. Okay. Then from there, let's just move a bit. Guys, I don't know what's difficult to just mute yourself if you are in this session. Okay, then let's just move on to the next one here. I just want people to pay attention. I don't want you to read something, but you don't understand what does that mean, right? The company is registered as a Category A VAT vendor, making 90% taxable supplies. Who wants to tell me what is the implication of being told that these guys, they make 90% taxable supplies? What does that mean from a tax point of view? Maybe from a VAT point of view. Okay, if no one is available to discuss that, I'm willing to go through. Right. So guys, remember something that is very important. Remember, let's say I'm running a business. So let's say this business, it's having, let's say, 80% taxable supplies from a VAT point of view, then maybe 20% non-taxable, right? Supplies. So let's say I incur an amount of okay. I'm not so sure if I can Sisanda, I don't know if you want to say what you're saying, and Lindam, if you want to say what you want to say there. Okay, but let's say we bought something for 115,000, VAT inclusive. SARS require you, when you are claiming an input, the only input that you're going to claim is 15 over 115 times 115,000 to the extent of your taxable supplies. So that's what it simply means when you have something like this, right? You need to make sure that you only claim VAT input to the extent of your taxable supplies. But of course, if you are doing above 92%, I don't just remember if it's exactly 92, but I think you can confirm that. But there is a certain percentage that for administrative purposes, they will just say, it's okay, we can approve you to claim the full 100%. So let's say you're doing 92 and above, and SARS has approved that you can claim 100%, you can go ahead and claim 100%. But if you have something where the 80% is the taxable supply and the non-taxable supply is only 20%, then in that instant, you can only claim to the extent of taxable supply, provided that the expense that have been done relates to all the items. Otherwise, if it only relates to the taxable supplies, you can still claim it in full 100%. Okay. 95%. Thank you. Thank you. Honolo. Okay, cool. Thank you. 95%. I hope that makes sense to somebody. Okay. Okay. Right. Then from there, let's just try to move a bit fast in reading our scenario so that we quickly do that question. I want to be done by that specific question by 3 o'clock, right? Okay, so let's just quickly look at this one. The company's financial year ends on the last day of June. So just to remember, for a company, your tax year will go in line with your year end, right? It's unlike individuals where we all know that our year end is 28 February, but for companies, your year end is your tax year end as well. So our year end is going to be 30 June 2022, right? Then I want you to read something. And always utilizes possible elections that would legally minimize its overall tax liability during any given year of assessment. What it simply means is they are trying to tell you that, let's say there's a sale of asset, involuntary disposal, where we can utilize the deferral of recoupment and deferral of capital gains. We are going to elect that section because we want to minimize our tax as much as possible. So I don't know if you guys have worked it through the deferral of recoupment, deferral of capital gains. So what we are simply doing is, let's say my building was destroyed by fire and I got some money from insurance company. So that money, once that happens, it is an involuntary disposal. And the insurance company has given me money. South African Revenue Services considers that as an involuntary disposal, right? And they also consider it to be a deemed disposal, right? It is a deemed disposal. So capital gains kicks in. But now what they do is there are certain requirements to then say, if that happens and you replace the asset or you rebuild the building, what SARS then do, they are going to say, now, the capital gains that you have and the recoupment that we have calculated, you have a choice to spread it over some years. So you spread it in the same way you are going to claim the allowance for the new asset that you brought in. That is the concept of deferral of recoupment and deferral of capital gains. SARS is just saying, we are not going to tax you on the recoupment this year. We are not going to on the full recoupment this year and the full capital gains this year. What we are going to do is to say, look, we understand that you had an involuntary disposal and you replaced the asset, so it was not your intention to dispose the asset. So what we are going to do is, if you are going to claim the new asset, let's say you are going to claim 5% every year as your capital allowance or 10%, it also follows that your recoupment, we're going to spread it in that way over the coming years. Your capital gains, we're going to also spread it over just like that. So they just don't want you to put you in a tax burden like now, because they understand that it was an involuntary disposal. That's what exactly that statement is talking about, where they say they elect any possible elections that would legally minimize any overall tax liability. Then from there, the accountant of TS provided you with the following information for the 2022 year of assessment. The sales amounted to 6,548,900 for the year of assessment. Then the cost of sales consisted of the following: opening stock. We do have the opening stock, we have purchases, and we have the closing stock. Just to keep in mind, purchases, we normally do with section 11A. That's a general deduction. Then when it comes to the opening inventory, that's section 22, subsection 2. Then when we deal with the closing inventory, that's section 22, subsection 1, right? So those are the sections that are applicable for the inventory and for the purchases, right? It's something that you just need to start knowing now. You guys are going to be getting into open book assessment approach. And that is, so the trigger for deferral of recoupment is involuntary disposal. Yes, that's one of the triggers that is very, very important. Okay. All right. Then from there, the market value of the opening stock was 1,565,500 on 1 July 2021. And the market value for the closing stock was this. Just to keep in mind, guys, when you talk of opening and closing stock, Remember, we always apply the rule lower of costs or market value. So you always do the lower of costs or the market value. So it's something very, very important there. Then we come here on 24 April 2022, TS purchased the raw material at a cost of 1.5 for its IPL cricket bet, ranged from a local supplier in Durban. The raw materials was not yet delivered as at 30 June 2022 due to the supplier experiencing shortages. The raw material was not included in the closing stock above, but these are purchases, meaning to say they might be included in them. I don't know if it's included. They purchased it for 1.5. So obviously they are not included in this amount because this amount is even way less than the 1.5. So it's not included there. So the 1.5, we need to know what are we going to do with that amount, but it's not yet, I think something very, very important here. If something was not yet delivered, I don't think we then need to consider it as a purchase in 2022, but rather we are going to consider it to have been incurred in 2023. So this is going to be moved to 2023. So the deduction will only be allowed in 2023 for that because it's not yet delivered, right? It's not yet delivered. So the risk and rewards have not yet transferred, so we can't deduct that. Then from point number 4, gross local dividend of 178 accrued from South African company during the 2022 year of assessment. So you guys, you need to tell me, what do you do with the local dividends? Do you think they will be exempt, or what do you think will happen on those local dividends? Dividends are subject to what, guys? Dividends are subject to an exemption. Okay, let's see. Yeah, they are exempted. So we're going to show them as gross income. Then we're going to fully exempt it in full. So dividends are going to be exempt in full. But one of the things that I think student needs to understand, let's say the gross dividend was 100, but when it reached to the one who received it was 80 due to the dividend tax. When we calculate gross income, we want to see the full 100,000. So you show the gross income as a gross dividend, not net of the dividend tax. I think that is very clear. You need to show the gross dividend. You fully exempt it. So don't try to use the net that was received in the bank. That's not correct. You use the gross local dividend. The reason why we are exempting it, it is subject to dividend tax. Okay, then let's go to point number 5. TS paid an amount of 2.5 towards salaries. The company does not apply IFRS 9 for financial reporting purposes. And the debtors clerk indicated that the list of doubtful debts for the 2022 year of year end amounted to 678. 85% of the list of doubtful debts at the year end in arrears for more than 100 days, but less than 120. Then 15% of the list was in arrears for 40 days. The list of doubtful debts for 2021 year ended amounted to 1,358,000. The entire 2020 list of doubtful debts has been in arrears for more than 120 days. Guys, if there's one person who is part of our usual classes, if you are willing to volunteer to do this class, please come and shine and brag. I would want someone to come and tell us what to do with this information once we get to it. If you are there and you are willing, you can just send me a message or a text to say you are willing to make a contribution. Okay, I'll leave this one. I want to see if someone is willing to shine and brag. You received the following information in respect of assets held by the company. During its 2021 year of assessment, the company acquired the first floor of a new, very popular modern 10-story building at a cost of 1.6. So I think what is very important with this information is they acquired the first floor. What does that mean? They acquired part of a building. They did not buy the full building, right? This is something very important, okay? Then from there, the land was trivial, meaning to say we don't need to worry about the land. And it was immediately brought into use as its new office space. If someone can tell me here, guys, when we have office space, let's say we have office space, are we going to claim any allowance there? And if there's any allowance, if you can tell me which section do we apply for the office building? Office building, guys. Okay, I'll give you a chance to think about it. No allowance for admin building. Okay. Very important there. That's a very important principle that you are bringing in there. Okay, that's fine. I think we really need to think about that. Okay, which sections do you get under section 13.1? Like which kind of a building do you get under section 13.1? Okay, I'll come back to that. Okay, I think it's a very good discussion that we're going to have. Okay, section 13.1 is manufacturing building, right? And what do we get when do we get section 13 queen? What kind of a building do we use for section 13 queen? Section 13 queen, commercial building. Okay, thank you. I think you've answered what I wanted you to answer. So now what you guys need to tell me is, why are you then saying that they are not going to get an allowance for the office building? Maybe just tell me what you think there. Why do you think that we should not get an allowance for an office building? I understand in your accounting modules you have been told SARS does not allow a deduction for this. But I want us to get into the idea of understanding, why are you saying we don't necessarily have we are not going to have a deduction there? This is not for the purpose of trade in direct line of production. Okay, so yeah, that's a serious one, and I think we are going to be conflicted there. If you have your X, guys, I just wanted to listen very carefully to what the Act says. Listen very carefully. Section 13 queen, deduction in respect of commercial buildings. They shall be allowed to be deducted from the income of the taxpayer an allowance equal to 5% of the cost to the taxpayer of any new and unused owned by the taxpayer, right? So I think what is very important, section 13 queen says any new and unused building, right? Okay. Was this building a new one? It was a new building. Can you see that? 10-story. And guys, what is the definition of a commercial building if I'm to start there? What is the definition of a commercial building? I would consider this to be a commercial building. I would consider this to be a commercial building. Right, there's no way where they say this is not going to be allowed for deduction. We are actually going to claim an allowance there and we'll apply section 13 queen. And what is very important is we are taking it to be a commercial building. I understand where you're coming from. In accounting, there are instances where you're told that maybe SARS does not allow an allowance on this kind of a building. probably it was not new, right? But if it's new and it's not used in the process of manufacture, it's not a factory, you can still go and claim Section 13 Queen. Unless if you're saying the word commercial means something else. But once you're using a certain building as part of your office space, I'm assuming that you're using it for commercial purposes. Okay, producing income, right? I think this is something very, very important. You know, the way they're producing income, what they will be trying to say there, remember if I have gross income, let's say I have gross income there, and the full amount is exempt. I no longer have income. So my income is zero. But if what I'm doing, that business that I'm doing is going to give me something as income, that's the income that they're talking about there. That's the income that they're talking about. But there's just a misread of the section where people think that it should be more like it is a commercial building. It is a building that is primarily used in the business, trade, income generating activities, rather than, yes, actually the act put it that way to say they wanted you to avoid claiming using the residential building, like they didn't want you to claim anything that is used as a residential accommodation, because residential accommodation, it has its own section, the Section 13 6, right? So that's the one that you use to claim that. But for now, I think I like that point McDonald there. So yeah, I think I understand why you thought maybe we should excuse it. But guys, just remember, if you have seen one of the Excel sheets that, yes, we're going to do the 55%, why they acquired a portion of the building, 100% there, then you're going to apply 5%. But if this building was not new, you can't claim a Section 13 Queen. Section 13 Queen is only allowed on new building. I think if you have seen one of the Excel documents that we put as a summary for capital allowances, we highlighted which section is applicable to new building, which section is applicable to the buildings that are owned by the entity. Okay, thank you, thank you. Right, so remember what we're trying to do there is to try to just make sure that you guys, when you go to your CTA and so forth, you have a better understanding. So I want you to see something here that is very important. On 1 April 2022, the company received an offer from a serious buyer that is not a connected person. Okay, the reason why they are saying it's not a connected person, remember, if you get an offer from a person who is a connected person, we need to make sure that we consider what is the market value. We don't just look at the transaction as it is. We need to assume a market value. Although the office space was not for sale, the offer was too good that the company could not refuse and subsequently sold the first floor of this building to Daniels for an amount of 2.5 on 30 April 2022. One thing that I just want everyone to understand on this, I think it goes back to the issue of, remember, when you buy something and you immediately sell it, SARS might want to treat that to be more of an income nature, not capital in nature. But the reason why they are telling you that the offer was too good and it was not a connected person, they didn't do much to improve the building before they sell it, they are just trying to tell you that they did not cross the Rubicon. Remember, one of the things that we need to look at for us to consider something of to be income in nature or capital in nature, we need to check whether they've crossed the Rubicon. But in this case, they did not cross the Rubicon, so we're going to apply the normal capital gains principles. Capital gains is going to come in there. Then from there, on 1 October 2021, TS purchased a laptop computer for the company's financial manager at a cost of 5,870. An additional 500 was incurred for the installation. So this is going to be more of a Section 11E allowance. Guys, Section 11E, laptops are going to go for 3 years. Software is going to go for how many years? The software is going to go for how many years? It's going to go for 2 years. But you guys, you need to tell me, when you have something like this, what does Section 11E say regarding assets that were purchased for less than 7,000. What does Section 11E say? Because if I combine the two amounts together, they are going to give me 6,370, right? But that is less than 7,000. What does Section 11E say? Am I going to apply the 3 years for the laptop and 2 years, or am I allowed to deduct it in full because it's less than 7,000?
You're allowed to deduct it it full.
Yes, thank you. So when you have Section 11E and the amount is for less than 7,000, then you are going to be allowed to deduct the full 100%. You don't need to divide by 2 years and 3 years for each of the items. So you're going to just put it together, you deduct it in full 100%. You need to tell the examiner that the expenditure is less than 7,000, therefore allowed to deduct in full. Okay, then from there, in the early hours of the morning of on 1 June 2022, fire destroyed the company's rugby ball manufacturing machine. The following amounts were received from the insurer. Loss of profits was given 158. Then there was a loss of machine, which is 160. All right. The manufacturing machine was originally purchased new on 1 December 2019 at a cost of 246,800. The machine needed to be replaced, and TS purchased the second-hand manufacturing machine for 125,000 on 15 May 2022 to replace the one that was destroyed in fire. The new machine was brought into use on 1 December 2019 and replacement machine on 15 May 2022. So it's very important to realize that the replacement machine was bought second-hand, which means it will be claimed at a rate of 20. So if I'm going to have any recoupment or any capital gains, it's also going to be spread exactly in the same ratio. That's what I mean. The new asset that we are bringing in, sorry, let me not say the new asset. Let me say the replacement asset that we're going to bring in, it was bought second-hand, which then means that we are going to claim it in the ratio of 20%, 2020, 2020. It also means that if we are going to have a recoupment and a capital gain, we are not going to tax it now in full, but we're going to spread it. So let's say our recoupment is 100,000, 20,000 is going to be in year one, 20,000 in another year, 20,000 in another year. The same with capital gains. Let's say our capital gains is 30,000. We're going to spread it 20%, 20%, 20%. I hope that makes sense to everyone, and we are ready to put the answer down. Okay. So let's start, guys. I'll try to be a bit quicker. I think I've explained most of the things, and please just pay attention. Leave your phone alone and focus on what we are doing. It can help you a lot if you listen very carefully. Right, let's start with the sales. It amounted to 6,548,000. Are we gonna put it as it is? 6,548,000. So we're gonna have the sales. 6,548,900. Is that right? Okay. Then we go to the next one. We don't. So what we do with the cost of sales, I just wanted it to be very clear to say what we do with opening inventory. We deduct. So we're going to bring opening inventory. We deduct it. Deduction in terms of section 22. 2. Okay, opening inventory is the subsection 2, right? But remember, you need to write lower of cost or market value, right? So what is the market value for the opening inventory? I can see that the cost is 1,579 and the market value was 1,565. So if I'm to take the lower, which one am I going to take? Yes, we're going to subtract for sure. Guys, I said for opening inventory, we look at the market value. and the cost. We take the lower. So which one are we going to take? You need to tell the examiner that I need to take the lower off, right? 1565, 500, right? 1565, 500. I want to see you writing the lower off. Very, very important. Then the next one, I'm going to go to the purchases. Then we're going to look at the closing inventory as well. So let's go to the purchases. Right, purchases is deducted in terms of section 11A. Right, in terms of section 11A. Okay. So the purchases, we just take it as it is. So we're going to take what? What is the purchases? It's 855, 855. Right? So I'll come and put 855. We are also deducting 855, 855. Then we go to the closing stock. Guys, I wrote the word inventory. I don't want to see it when you're doing text. Right? Stock. That's the word that they use there. Right? Opening stock. Okay. Closing stock, how much is the closing stock? Closing stock is 574. 574. 845. Is that right, guys? I add it back. It's more of a recoupment. I'm recouping. Any question? But I want to talk about the purchases that were done here. What did we say about these purchases, guys? So, guys, for the closing stock, we looked at the cost there and we compared it to the market value. So the lower is the cost. Are we together? Just to be very clear there. Then we also purchased the 1.5 there, right? Right? So these are purchases not yet delivered, right? Raw material purchases. I'm going to come and say raw material purchases. We said it's going to be considered to be deemed to have been 2023 deduction. So it's going to be next year. Why? Because it's not delivered. Cool. Let's go and check what you have here, guys. Yes, it relates to the following year. So I'm going to put a 0 there. You don't have to leave it without telling the examiner why you are not doing something. So that's why a lot of students lose marks, because they don't necessarily talk to the examiner. You are discussing with the examiner and give a full perspective. So we are done with the first part, 1, 2, 3. Let's go to the gross dividend, guys. What did we say? We said we're going to include it. So in terms of the dividend, guys, so this is in terms of section 11, sorry, section 22, 1. So let's look at gross dividends. When we look at gross dividends, right? So when we look at dividends, which paragraph do we use to include it in our taxable income? We use the gross income definition, paragraph K. And it will be exempt in terms of section 10(1) K. Okay, so the K is in the gross income, it's paragraph K. Then in the exempt in section 10, it's also, you can also get it around paragraph K. I hope that makes sense. It's section 10(1), paragraph K, gross income, paragraph K. The gross income, exempt, same paragraph, but different sections. I included, and then, okay, cool. So we're gonna include it as 178,600. Then we're gonna deduct it as well as the same amount. Don't try to show the examiner that you are very clever and you don't want to include it. You can include it just like this. It's okay, right? Don't try to show the examiner that, I mean, I'm clever. I know it's 0, so I'm going to leave this completely. You lose marks. The examiner wants to see you including it and deducting it. And that's the rule. When you fill your tax returns and you're doing it on tax team or e-filing, whatever, you need to show what you received, and it will be exempt automatically. So, okay, then from there, let's start with the salary paid of 2.5. Should we deduct it? the salary paid, should we deduct it? Salaries can still be deducted in terms of section 11A, guys, because it's a general deduction. Okay, how much is the salary? Thanks, guys. You're on fire here. Yes, we're gonna deduct. Thank you. You guys are participating. That's great. So the salary is 2.5. I think we all agree there. 2.5. So we're gonna deduct it. Okay. Then from there, what is the right? Here you need to listen, guys. Remember when you look at, I think I'm gonna just need to go to this one and just have, guys, those who attend with me, I think there are a few people who were there in that session. If you're willing to take us through. So guys, when it comes to the allowance for credit losses, okay. Allowance for credit losses, when you deduct for allowance for credit losses, it's very important that we are very clear in terms of how does it apply. We have the one scenario where the company uses IFRS 9 and the other option where they don't use not IFRS 9. So you need to understand whether we apply section IFRS 9 or we don't apply it. But what does that mean? When we apply IFRS 9, right, we do 40% for lifetime credit losses. So for lifetime credit losses, we do 40%. Then we do 25% for 12-month credit loss, an estimate of 12 months. They will give you that in the question. Even for financial reporting, when you do financial instrument, they give you that information. So I think it's very, very important attempt. Let's see, Tracy. Let's see what she has done here. I think that's very important. Let's just see here. Oh, sorry, what am I doing now? Oh, sorry, what am I doing now? Okay, what she did here, she deducted 2.5. Then she said doubtful debt current. So just tell me something. Trecia, do we deduct the current and add back the previous, or how do we go about it? Just in general, do we deduct the current year allowance for doubtful debts portion, or do we add it? Add back previous and deduct current, right? So that's very important. So what I'm going to do is allowance for doubtful debts, allowance for doubtful debts, guys. I want it to be done in this part. I wanted to, then the prior year, I'm going to add it back. So prior year, add back. Right? Then current year, for doubtful debts, current year, this one you are going to deduct. But what I'm saying is, if you apply IFRS 9, you're going to do 40% to the lifetime credit losses. So let's say the lifetime credit losses is 100, you just do 40% of 100. Let's say the 12-month expected credit loss is 50, you're going to just say 25% of the 50. So that's what it means. 40% on the lifetime, 25% on the 12 months expected credit loss. That's when you apply IFRS 9. If you don't apply IFRS 9, anything that is above 120 days, you do 40%. Then you apply 25% to something that is 60 days to 119 days, right? So anything between 60 up to just less than 120. So if it's above 120, you apply 40%. 60 to 120, you apply 25%. Anything below 60 days, you are not allowed to deduct anything. Is that clear, guys? Is that clear? I might have run through there, but let's just make sure that it's very clear. Okay, cool. So in this case, they are not applying IFRS 9. So what are we going to do? They said for 2022, the amount that they have is 620.78. 85% of that is for more than 100 days, but less than 120, which means we are going to say 85%. Then we multiply by the number. Then we also multiply by 25%. It's below 120 days. So we're going to apply. Just tell me if I'm right there. I just need to make sure that I'm correct there. Okay, let's just see something here. This is 2022, right? So we are saying 85% of the lists have been in arrears for more than 100 days, but less than 120. 15% of the list was in arrears for 40 days. The list of the doubtful debts for 2021. So 2021 is separate. So let's start with 2022, right? So for 2022, the one that we want to deduct, I'm going to take 85% of this. Then I multiply it by 25 because it's less than 120 days, but it's above 60. So I'm going to do 678 current year, 678,000, right? Then I'm going to multiply it by 85%. Then I'm going to multiply it by 25%. I hope that is very clear. Then I'm going to be deducting that. 678,000, then I multiply by 0.85, then you multiply by 0.25. Then you deduct that. It is in the current year. So there's nothing else that we need to deduct. We don't have anything above 120. We only have between 60 to 120. That's where we apply the 25%. Then in the prior year, we had, so in the prior year, amounted to 1,358. The entire 2020 list of doubtful debts in arrears for more than 120 for the 2021 year end. I just need to be very careful here because there are more years that they've brought in now, right? But from what they are telling me there, I should just take this amount. I'm going to multiply it by, is it 40%? Because they are more than 120 days. So we're going to multiply by 40%. So I'm going to take 1,358. So I'm going to take 1,358. Then I'm going to multiply it by 40% because they are all above 120. But I'm adding it back. 135, 8123 times 0.4. We are adding it back. Okay, any question? Okay, cool. Thank you. Guys, do we understand IFRS 9 being applied? No IFRS 9, do we understand? Do you understand, guys? Just confirm if you can understand this. Guys, are you sure you can see clearly? I just don't want to have things that are very small and you can't see clearly. Is it better now? Okay, cool. Right. All right, cool, guys. Let's move on. We have a long way to go, guys. We still have a lot. But these are, you see what I like about this. Guys, if there is a doubtful debt is going to be deducted in full. A doubtful debt will be deducted in full. I don't have it, but I'm going to just show you. If we have a bad debt or a credit loss, bad debt will be deducted in full, right? Deducted in full. So when I say bad debts, it means we have tried to get some recoveries, but we were not able to get those recoveries. That's what we call a bad debt. But one thing that I want you to be very clear is provided it was previously included in gross income. I gave someone an example to say, think about it. So let's say we have a bad debt of 100, but we are told that the other 80 relates to sales that we did on credit sales, right? Credit sales, it relates to credit sales. Then the other 20, maybe let's say the other 15 related to the loan capital portion to an employee. Then we are then told that the other 5 relates to the interest on the loan to employee. So let's say, guys, our total is this. Who can tell me which amounts are allowed as a deduction there? So what I'm saying is, let's say the total for bad debts. So this is the total bad debts. But it's made up of the bad debts as a result of credit sales, loan capital portion to the employee, and interest on the loan to the employee. So which ones will be allowed as a deduction? The one that relates to the credit sales. What about the loan itself? Will it be allowed? What about the interest? All of it. But remember, the requirement is that provided it was previously included. Yes, the credit sales and the interest. Well done. So the interest will also be allowed as a deduction, because when you earn interest, you're likely to also include it in your taxable income. So these two would then be included. They normally give you something that looks like this. Please go and shine when you see something like this. But the loan capital portion, it was not previously included in gross income, so it won't be deducted. But in this case, is 0. This is just for illustration purposes, guys. Okay. But in terms of sections, guys, which section is applicable for allowance for bad debts and which section is applicable for bad debts? Sorry, if you are with us, I think you get tired of us talking about these sections. That's the rule. We can't just talk about deducting. Where are you getting it from? There are sections that speaks to this. So why are you not telling us about those sections? I'll be doing injustice if I come and present and I'm not doing exactly that. So I don't do that, guys. So which one is applicable for the allowance and which one is applicable for the, okay, let's see. Bad debts, it's I, then section 11J is what? I is bad debts, J is your allowance. Thank you. So J is your allowance, section 11J, right? Then this will be section 11I. You guys, you are shining. Okay, cool. Right, those are the sections that are applicable. If you have any questions, please feel free to let me know. Any question, guys? No questions. I can move on now. Okay, so let's move on to the next one. So are you happy with this treatment, guys? Happy? Look at how many marks you'd have earned there. Very good amount of marks. Let's go to this question here, guys. We acquired this building in 2021. So we acquired first floor, right? Part of the building. So we acquired part of the building first floor. I'm going to consider it as a commercial building. First floor. Guys, once you acquire part of the building, it means you are going to only claim the 55% of the cost. That's what you're allowed. So I'm going to apply section 13 Queen here. Section 13 Queen. All right, so what I'm going to do is I need to know what was the cost there. What was the cost, guys? If we can be faster, guys, so that we can move on. What was the cost of this building? The cost was 1.6. Guys, just to hold on. Just give me a second, please. All right, sorry guys. I was just responding to something. Yes, sorry. I think we have one of our auditing CTA class running, so there was a message coming from there for something. Okay, cool. Yeah, let's move on. Okay, let's move on, guys. Right, so I'm happy with that. You know, when you can get to understand which section we are dealing with. So what is the cost of our building? The cost is 1.6, right? So I'm going to come and put the cost of 1.6. So because this building was later sold, I need to just have an understanding of what's happening in that building in terms of the allowances that have been claimed so far. So if I come here, because it was bought during the 2021 year of assessment, so I'm going to claim an allowance in 2021. I'm going to claim another allowance in 2022. Remember, when you use section 13, either section 13.1 or section 13 queen, there is no apportionment of the allowance, right? So I'm going to have a capital allowance, right? So I'm going to say capital allowance. So I'm going to do the 2021 on its own, then I'm going to do the 2022 on its own. So the capital allowance, guys, remember, because it's part of a building, so I need to do 55% times 1.6 until 3, then I'm going to multiply by 5%. Okay? So that's what I'm going to have there. But remember, okay, so it's going to be a deduction of 0.55 times 1.6. Then I'm going to multiply by 0.5. Right? That's what I'm going to deduct. So the same calculation is going to be applicable for 2022. So I'm also going to deduct exactly the same amount. But let me be reminded of the fact that what I have in 2022 should also come to the taxable income. So I should show that I'm going to make a deduction as well, right? So I'm going to also have that as a deduction in the current year. Because remember, we are calculating for 2022. So let me put 2022, right? So whatever I have there should also go into the column for the current year that I'm dealing with. So if I look at these figures together, if I take the cost minus these amounts, you are going to see that I'm going to get a total of 1,512,000. What do I call that? That is called a tax value or a tax base, right? Then what I need to do is to go and do a calculation for recoupment. Who can tell me how we calculate recoupment? So we sold this asset for 2.5 and the cost one was 1.6. So how do we calculate recoupment? Anyone to shine here? Anyone to shine? How do we calculate recoupment? Recoupment, those who attended with us, we said what? Proceeds less tax value. There's something that I want on the proceeds there. So are we going to take the 2.5 minus the tax value? It's very important that we take the proceeds limited to costs. Limited to costs. So if the proceeds happen to exceed cost, please use cost less the tax value. Okay, so what does that mean? What is our proceeds? It's 2.5, but I'm going to limit it to what? So I'm going to take the 2.5, but I'm going to limit it to the cost. Does that make sense to somebody? We take this, we limit it to the costs. Right, so 2.5 limited to costs, which is 1.6. Right, so we are going to say 2.5 minus, so it's going to be limited, so it will be 1.6. Then we subtract the tax value of 1,512. Right, you can't use something above the cost on that one. So our recoupment is going to be 1.6 minus 1,512. Okay, so that is going to be our recoupment. Can you see something regarding recoupment, guys? I want you to see something. Can you see that recoupment? It's basically the allowances that you have claimed in the past. Yeah, so ideally, that's why that issue of limiting to cost. Some students, what they can do is they can still go and say 2.5, then they must subtract 152, but they will say whatever they get, it should be limited to the allowances that have been claimed in the past. Is still correct. That will be still correct. So this one is going now to come here. There's no, we don't need to do anything regarding the deferral. Deferral of recoupment is not applicable in this case because there was no involuntary disposal, there was no replacement. Okay, so remember, it happens when there's an involuntary disposal and there's a replacement. Those are the two requirements. Okay, so let's go ahead with the capital gains. So let's look at capital gains calculation. I think I shared one of the recordings that we did, the last recording that we did on capital gains. If you still have a problem, please reach out. So we need to get something called adjusted recoupment, right? Sorry, adjusted proceeds. The Act provides that when you calculate adjusted proceeds, you look at the proceeds that you received. So we had the proceeds of how much? We received the 2.5. Is that right? Proceeds of 2.5. Right? And those proceeds must be adjusted. We're going to less the recoupment because the recoupment is already taxed. So we're going to subtract what we have already taxed, the 88. So if we do that, we are going to get something called adjusted recoupment. Sorry, adjusted proceeds. Right? That's what we'll call adjusted proceeds. Then from there, we're going to look at the tax value. So our tax value, we've already calculated it. What is our tax value, guys? Our tax value is this one. So if we then look at the difference between this and this, that's your capital gain. So that's how we calculate capital gain. Although everyone can easily see that our capital gain was 900,000. Because if you look at it, if you look at 1.6 and 2.5, it's very clear our capital gain is 900, right? The difference there is 900,000. We can all see that. But you get marks awarded for this kind of calculation. That process, that's where you earn marks. There is no one who knows this process who ever failed this module. There is nothing like that. No one knows this who is going to fail this. There is no way. I've never seen anyone understanding this whole process and still failing. Okay. So when we have capital gains, guys, what do we do? So that's the capital gain from the first asset. Is that right? Yep, guys. You can unmute yourself. Let's hear your voices, guys. At least I will know whether we are still hearing each other. Yep, can we proceed? We are
yes, we're happy.
We are almost done. I didn't stick to my time. I wanted to achieve something before certain time. So I think we should be happy with that calculation there. We have a capital gain. We've calculated it. And yeah, I think we are fine there. Okay. Okay. I think from there, what's next there? What's next? What else do you need to look at there? Guys, I think I need to emphasize this and just make sure that it's very important. Recoupment, it's always going to be limited to the previously claimed allowances. I don't know how to overemphasize this, but recoupment is always going to be limited to previously claimed allowances. Okay. I hope that's very clear. Don't worry about time. Okay, no, that's fine. But yeah, it's just that tomorrow is Monday. You just need to be ready for other things. But it's fine. We still have time for this session. I'm just saying I want it to be done to a certain extent, but it's fine. If you're happy with the way we are now, I think that's fine. So I think we are done for now on that one. Then the next thing that we need to look at, let's just look at something here. Okay, we're still going to get to this point here. So let's quickly go to what happened to the laptops. So we are done with this one. So let's now go to the laptops. Okay, so I'm going to say laptop. The purchase itself is capital in nature. So you don't need to do anything with the purchase itself of the laptops. But what you need to deal with is the allowance, right? Section 11E. So we're going to do section 11E. You need to tell the examiner that less than 7,000, therefore, full deduction. Right? Less than 7,000, therefore, full deduction. Okay? So what are we going to deduct? How much is it? 5,870 plus 500, we said it's 6,370. 6,370. But remember, section 11E, you do an apportionment if you are to do a proper calculation there, if it's above 7,000. You need to look at the number of months and all those things. I think that's one of the sections that requires you to do an apportionment. Okay. Then from there, what else, guys? What else should we look at? If you look there, there was some insurance that we received. So you guys are going to tell me if we are going to include these insurances. So there's an insurance for the machine. So this one will be considered as the proceeds for the purpose of calculating CGT. So we're going to do a proper calculation of CGT. But what about the loss of profit that we were given? So we're given 158 as a loss of profit. What do we do with it? Insurance claim. That's on profit lost. Tell me, how do we go about it? We're going to include it, right? Because if you lose profit, but someone gives you back, you're going to include it in your taxable income, 158. It's taxable. It is supposed to be included in the gross income. But this one is a deduction, guys. Just keep that in mind. Okay. What am I doing here? This is supposed to come here, not there. This is also supposed to come here. Oh, so we have not yet done anything with this capital gain. Did you guys realize that we didn't do anything with this capital gain of 900? So we're going to say taxable capital gain. Capital gain. So the taxable capital gain is going to be 900,000. The reason why I wanted to leave it, I'll show you something, guys. Remember, we need to aggregate okay, let me not do this. We're going to need to aggregate the capital gain at a later stage, right? We need to first aggregate the capital gain. So let's just keep in mind that we have a capital gain. So we need to aggregate it, right? Okay, we're going to aggregate it to something. Right, let's go to the laptop itself. So the laptop itself was also later. Let's just see. Now it was now about the machinery. So the laptop, we are done. So let's move on to the machinery. We are almost done, guys. Just to pay attention. So we want to look at the old machinery. I'm going to come and say old. Old machinery. So the old machinery, guys, I just want you to understand something. It was bought at a cost of this on 1 December 2019. So we're going to have a claim on 30 June 2020, right? And we're going to also have another one 30 June 2021, and we're going to have, it was then sold in 2022, then we're going to have 22. So we're going to claim for 3 years, okay? What I can come and do here, I'm going to come and say the cost was, what was the cost of the machinery? The cost for the machinery was 246. Do you agree? 246,800. 246,800. 246,800. Then I'm gonna claim allowances. This machinery, when it was bought, it was new. So in first year, they would have done 40%. Capital allowance. So I'm going to have 2021, then I'm going to have 2022. Maybe let me say 2021, 2022. Then I'm going to have 2023. Sorry, 2020 and 2021. So I need to start with 2020. Then I'm going to have 2021. Then I'm going to have 2022. Right, so the first year we do 40%. I think we're in agreement there. We do 40% in the first year. Is that right? So in 2020, I'm going to do 40% of 246,800. So I'm going to take 40% times 246,800. Then you're going to go into the second year, it'll be 20% of the 246,800. So if you go, that's 20% times 246,800. Then you go to the next one, it'll be 20% as well, times 246,800. So it will be equal to 20% times 246,800. Okay, cool. Guys, just to keep in mind, the one for 2022, we also need to see it in the taxable income. So we are also going to deduct it in our taxable income calculation. So we're going to deduct it here. I hope that makes sense. You always need to show this, and those are easy marks. So now, if we put this together and we do this, maybe let me just put it in a box like this, then I do this, then I'm going to get my tax value. So that's my tax value. Tax value. So the tax value here, the tax value is this one. And I'm going to calculate what I call recoupment, right? So the recoupment is going to be considered selling price. So let's look at the selling price. So we look at what we received from the insurance. We got 160. It should be limited to cost, but the cost is already low. So we're going to take the 160. So I'm going to take the 160. 160, right? Then I'm going to limit it to what? So it's 160 minus what? Minus the tax value of 49,360. All right, so the recoupment that we are going to get here is equal to 160,000 minus 49,360. Then we get 110,640. But remember, in this case, we are not going to put the full 110 in our taxable income. We are not going to put the full 110 in our taxable income, but rather we are going to defer it, right? So we are going to talk about something called the deferral of recoupment. So guys, what I want you to understand is this. Because the asset that we are bringing in, it's a second-hand machine, which means they're going to apply 2020, 2020. So it means this recoupment, I'm only going to include deferral of recoupment. So I'm only going to include only 20%. So I look at the claim that I'm going to be making on the replacement asset. So I'm only going to include the same percentage because I'm going to be claiming a deduction of 20% of the cost because it's a second-hand machine that was replaced. Is that clear to everyone, guys? Does it make sense to somebody? Does that make sense to somebody?
Yes, sir.
Okay, cool. Then I can go ahead and you can do the calculation of capital gains immediately there.
Hi, sir.
Yes.
Can you please repeat again the 20%? Okay, like, can you please repeat again the deferral of recoupment?
We said when you calculate your recoupment, you include the percentage that is similar to the percentage that you're going to be claiming as a deduction on the replacement asset. So the replacement asset is second-hand asset used in the process of manufacture, which means 20%, 20%, 20%. So it also means that the recoupment should be included at a rate of 20% in first year, second year, 20%. Does that make sense?
Yes, sir. Thank you.
Okay. So the second-hand machine that we are looking at is what we are going to replace. So it does 20%, 20%. So that's why we did that. Right. So it's also important that, so I'm going to claim, let me just say, okay, let me just come to the capital gain here. So the capital gain, remember, we're going to look at proceeds. How much is our proceeds? Our proceeds that we got from the insurance was 160,000. Then we are going to less recoupment. But the recoupment that we less is the full recoupment, not necessarily what we already included. So we less the full recoupment, right? So the recoupment is basically 110,614. So we are lessing it. So what it simply means is this is our adjusted proceeds. So this will be now our adjusted proceeds. All right, so if this is our adjusted proceeds to calculate capital gains, we're going to look at the tax value. What was the tax value? The tax value, we have already calculated it. And we said the tax value is 49,360. So there is no capital gain. But again, guys, I think it's very important that we clarify this. I think you all agree that there was no capital gain at all, right? If you think about it, we had an asset that we bought for 256. It was now sold for 160. So there's no capital gain. Capital gain is zero, right? So the capital gain is zero. Capital gain is zero. So it's this minus this. So we have a zero. But there's something that I have not yet done. Let me look at the new replacement machine. Replacement. So guys, if we had obtained a capital gain of, let's say, 70,000, in 2022, we're going to say 20% of 70,000 because the replacement asset, we are claiming the deduction at 20%. I hope that makes sense to somebody. Yes, it can be a new asset. So we're going to apply 40% in year one, 20% in the second year, just like that. Because we are just saying you are replacing the one that was burned in fire. So it can be new. Replacement machinery, we're going to just claim an allowance there. Allowance. So the allowance that we're going to claim on that one in terms of section 20C, we're going to multiply it by, we bought it for 125. I hope this has been very clear, guys, and I hope it's going to assist you. I need it in the next column. Okay, cool. Any question, guys, before I move on? Right. On the capital gain, guys, let's take what
Sorry,
we call
sir.
Yes.
Sorry to take you back, but I wanted to ask, the amounts that we receive from the insurance, are they not subject to VAT output?
Okay, I think the
Are we
question,
gonna?
that's a very good question. I think if I'm not mistaken, the question had said we should ignore VAT. It didn't say anything about VAT, but my understanding this question was like, oh, no. A company is registered for VAT. That's something very important now. Yeah, you know, you have a very good point there. Let's see. Yeah, that's a very good question. My assumption there was, you see, they are not telling us whether something is inclusive of VAT, something is not including VAT. Did you see that? Yeah, in this case, guys, let's just say we were ignoring VAT. But you are right. If these amounts include VAT, you should then reduce with the VAT. But it's just unfortunate that they didn't mention anything about VAT. They didn't mention about anything. So yeah, I think we should just leave it for now. But if the question is very clear, it's inclusive of VAT, we need to remove.
So if they are not clear, we assume that we don't calculate any VAT output on it.
Yeah, because maybe let me then put it in this way. If the insurer is paying you some money, so they said they received this from the insurer, right? What drops into your bank account? Do you think it will be including VAT or excluding VAT? The insurer will keep the VAT portion and send it to SARS, and they give you what is net of VAT, right?
Yes.
Yeah. So let's just take it that way in this instance. But in most cases, the questions, if they want you to put in the VAT, they will tell you that this amount is inclusive, this amount is exclusive. Yeah, it will
Okay,
be
thank you,
excluding.
sir.
All right, cool. Right, then from there, guys, I think we are done. We should just say what is the aggregate capital gain. So we're going to take the capital gain that we calculated on this one plus the capital gain that we calculated on top here. That's the aggregate capital gain that we are including there. So that's the aggregate capital gain. So we now need to say taxable capital gain. Taxable capital gain. So the taxable capital gain is 80% of this. Remember, the inclusion rate is 80%. Okay, so 720 will be the taxable capital gain.
Sir,
Yes.
sorry to disturb. On the capital gain of the 900,000, the on top one, didn't you say we need to come back to it or something?
Yeah, that's why I wanted to come back to it. I wanted to first get the aggregate capital gain. Then I then say 80% of that is included in the taxable income. So I already took it into account. If you check my formula there, that's where I'm getting that figure. Is that clear? But remember, guys, we also need to know what is our taxable income before capital gain. So I think if we come here, so this is my taxable income before capital gain. Just to make sure that you do other additions and subtractions that might be necessary, guys. For now, I'm not worried about that, right? So this is the taxable capital gain, taxable income before capital gains. I don't know if we are having the, something is not right there. Something not right there. Let's see. What did we do here? Oh, this is a deduction. Can you see what I've done here? Just to make sure that all the things, where it's supposed to be a minus, there is a minus, guys, just to make sure that, right? 88 is recoupment. That one is a deduction. Deduction, inclusion. Yeah, I think we can now add this together. Sorry. So we can just do, so what did I do here? How do you call it? I want to start from G what? G5. Okay, so that's our taxable. Oh, what did I do now again? Okay, so that's our taxable capital gain, right? So that's our taxable capital gain. Sorry, this is our taxable income before capital gain. Sorry about that. Right, then from there, this is our capital gain. So we're gonna just add these two. So if we take these two together, plus this, that will be our taxable income. Oh, what's happening here? Right, so I said this plus this. Why is my numbers giving me like this? So why is it giving me a 0 when I add them? Why is it giving me a 0, guys? Okay. Is the exemption of the dividend not the same as the one included in gross income? It's the same. Did you put different amounts? Okay, I get what you were asking there. Thanks for that. So it means this will be the new amount. But still, I think let's do this. Right, so that'll be the final there. I don't know what was happening with those numbers. So that's the taxable income. That's what the question asked you to do. They didn't say calculate the tax. So that's how you go about. This will be a long question in most cases. Just to make sure that thanks for that. Cool. Anyone with a question regarding this, guys? Maybe we can take a short break. Let's be back at. When you come back, we are not going to take long, guys. But please remind me to start recording when you come back. Let's come back at 15:50. Guys, don't leave the session. There are some few things that we need to talk about that are very important, and it will definitely help you. Please remember to resume recording. I think this one I need to put it in bold, in like that. Okay, cool, guys. We'll be back just now. Column 2 is the one that I was putting my final figures for my final figures for the taxable income. Column 1, the first column I just use it for the purpose of doing some calculations and transfer my figures. Okay. Wait, what happened yesterday? Okay, great. So yeah, we had a short break and we are now back. So let's try to go through these and make sure that we are all comfortable with what's happening there. Right, so guys, let's start now. And we're gonna move to some few questions. This is a 12-mark question. I always encourage students that you need to try to answer all questions that will be in the assessment. Try your level best to make sure that you answer all questions. Guys, just to check, how many marks is your assessment for tomorrow for text? How many marks will it be? Is it 40 or 60? 40, so nothing much. Capital gains, no more tax rules. Just make sure that you are very comfortable. I think one of the things that you might need to revisit on your normal tax, just think about a situation where maybe inventory was taken and was given to an employee. How do you deal with it from a tax point of view? Inventory was given to a charity organization. What does it mean? Just to try to look for examples that speaks to that and make sure that you have covered that. So this question, what it's requiring us to do is to write an email. So guys, just make sure that you do a proper email format and you end it properly. You are not supposed to lose marks on this because these are some of the easy marks. So just to make sure that that part, you have it correct, right? And they want you to discuss whether the amounts expended for each of the 4 transactions will be deductible in terms of the general deduction formula. So you're applying the general deduction formula to these principles. So I'll just hear from you guys what you think here. I am a paint artist for Tobisa Sports, and my job is to hand paint a small original Tobisa Sports Limited logo on every single piece of sporting equipment that is manufactured and sold by the company. I'm appointed as an independent contractor to the company and do not get reimbursed for any of the expenses incurred by myself. I send myself for my hours worked to the company at the end of each month. I work from home and I've converted half of my garage into a painting depot. The area covers 15%. So guys, I just want people not to be confused here. I think the main importance of this question is to just understand if something should be deductible in terms of the general deduction formula or not, right? So let's just try to stick to that, because someone would then say, but this speaks to an individual. So why are we talking about an individual? But still, an individual applies the general deduction formula. So I think we really need to just understand that and make sure that it's very comfortable. You're not going to be asked to redo this part again. Interest portion of the mortgage loan repayment on the mortgage loan on my home is 12,500. So there's a mortgage that this particular person have, right? Then this mortgage, it's for a house, but this house, let's just say 85% of the house is used as a home, and the other 15% is used for work. So now the question is, if they incur 12,500 as their interest, of course, the one from the home is not going to be deductible because these are domestic expenditure, but the one that relates to this 15% must be deducted. And do you know which case law deals with that, guys? So the one that relates to the interest that relates to the production of income should be deducted. But which case law supports that? Have you ever seen something like that? It's trying to get something quickly and see if I can get that general deduction formula. Just give me a second, guys. Just trying to bring the general deduction formula for you. I think I have something that you can benefit you guys. General deduction formula. I'm just trying to bring something on the screen. Almost done. I think I'm almost there. The general deduction. Okay, I think I got it. Let's see. This is about the general deduction, right? Deductions. I'm not sure if I have that now. I just want to see if we can see some of the case laws here. Maybe you can tell me. So the deduction, there's beggars, which are the case laws? Port Elizabeth. Guys, do you know any case law that we can use on this one? I think one of the case laws that we can use on this one, I think there's one for De Beers. Let's just check if we have De Beers case law here. It's not one of those that you are always used to. Okay, if you have Silk textbook, guys, you can check the case law of De Beers. But the idea with the case law of De Beers is just to say, if you have something that is, if there's a portion that deals with something that is in the production of income and a portion that is not in the production of income, the portion that is in the production of income will be deducted. Okay. Yeah, section 23B, what does it say, section 23B? Because remember, section 23 will be more like prohibited deductions, right? Tracy, I don't know if we are together there. So the case law that allows you to deduct a portion of what is applicable to the production of income and the other one not being deducted is the De Beers case law. Okay, we can go to the second one. You can have a look on that one in Silk textbook. It's very clear there. I recently built an additional storeroom next to my garage painting depot to store the equipment used for my trading activities, such as brushes, paint. The interest incurred on funds borrowed to build this storeroom of 15,600 for the 2023 of assessment. During the 2023 of assessment, I repaid 4,500 of the capital of the outstanding borrowed funds. So I think what is very important here, guys, there's a concept called inevitable concomitant, right? When you do something and something is not avoidable. So like if I borrow money and I'm building something that I'm using in the production of income, so that interest was very necessary for me to be able to get the loan. So surely the storeroom is being used to store my equipment. So do you agree, guys, that this is deductible? The 15,500 should be deductible. But however, the 4.5 is capital in nature, so it's not going to be deductible. So the 4.5 is capital in nature, not deductible. But the one that deals with the interest itself, because the interest is for something that we use in the production of income, then we should be able to deduct it. I think the case law that you can look at there is the Port Elizabeth electric tramway. It talks about inevitable concomitant, right? I hope it makes sense there. But in a nutshell, guys, 4.5 is capital in nature. 15.6 is interest incurred on something that we really need for the trade. Okay. It's no longer for the house. Here, the loan, the interest was for the house. So that's why we are pushing to say the 15% for what we are using for production and the other 85, that is not deductible. And if you go to point number 3, I also have an account at one of the large paint shops close to my house. Paints a lot limited. This account was settled at the end of every 3 years. Is settled at the end of every 3 years. My account is 7,000 per month. What do we do with this 7,000 per month, guys? So we are going to say 7,000. We are going to multiply it by 12 months. That should be fully deducted. Okay. Okay, that's an account. These are purchases, but we are just buying them. We are buying on account. These are purchases, right? So we are going to deduct this. So we are going to deduct this amount. Okay. Then from there, my wife assists me with some of the paints jobs, especially if we get a big order from the company. I pay her on an ad hoc basis a total amount of 30,000. If I hired a professional person to assist, it was going to cost 12,000. So guys, you need to tell me something here. This is something that is very, very important. Listen very carefully. We were supposed to pay 12,000, but because it's my wife, I'm now paying 30,000. Do you think SARS will allow me to deduct 30,000 where I was supposed to pay 12,000? Are we not trying to cheat SARS there? Let's see. No, we can't be allowed. True, it's excessive. You're deducting too much. If you're paying at 12,000, it's okay. So you can only be allowed to deduct what is reasonable, what you'd have paid at market value. So when you're dealing with a related party, just to know that SARS then becomes more interested in what is the market value. I think that's something very, very important. Really look at those items and just make sure that you are very comfortable. Guys, the VAT, do you think it's necessary at this point in time? I'm not so sure if you'll be asked the VAT, guys, because what I know is you're gonna get a question, a bigger question that will be taxable income. Maybe you get another question on capital gains tax. I think what we have covered, just to make sure that you are good with your capital gains, you are good with your capital allowances. If you're not comfortable with capital allowances, I strongly encourage you to revisit that one. Capital gains, look at trading, what do you call this? Working capital, where we talk about allowances, doubtful debts allowances, inventory. Try to have a look on that as well. Then, yeah, the basics of your gross income and the general deduction formula, special deductions. On special deductions, that's where we do section 11I, J, doubtful debts and all those things. They all fall under special deductions. But I think there's something that you also need to pay attention to. I want you to think about it. Let's say there's a lease agreement, and you're the lessee, right? So the rent that you pay is deductible. If you paid a premium to get this to happen, it's also deductible, but the premium can be spread over the period that you paid the premium for. Then let's say there were improvements. So when you deal with improvements, just to be very careful, the improvements are going to be deducted. So you deduct the improvements that you agreed with the lessor, right? So when you deduct these improvements, they're in terms of section 11G, 11H and G, right? 11H improvements. So when you look at these improvements, I just want you to pay attention to something, guys. The improvements, you look at the time when you brought it them, when they were completed. You look at the amount that you agreed on, then you divide it by the remaining lease period. But that is going to be limited to 25. So if the lease period is above 25, limited to 25. Then you make a deduction. And this deduction is, you can do an apportionment. If it happened that you had agreed to do 100, but you did 110, the 100 is going to be deducted as we are saying above. Then the extra over and above can be deducted in terms of section 13.1. What I'm saying in simple, if you agreed with the landlord or the lessor to say you're going to do an improvement of 100, the leasehold improvement allows you to deduct, to spread that 100 over the remaining useful life, remaining rental period, lease agreement period, lease term. However, over and above, you can claim that extra of 10 using the rules of section 13.1. So you can now say that 10 in year 1, you apply 5%, in year 2, you apply another 5%. I hope I make sense there. Okay. These are some of the tricks that you'll be seeing as you start doing CTA, and if an examiner is rough, you can also sit at third year level. Guys, at this point in time, I think we can end here. But please do feel free to come through if you have any further question. If you want more, you can always join us, guys. I think we do classes on a weekly basis, and we are looking forward to, let's see, when dealing with lease agreements and we are LDC, do we always divide the amount by the number of contract year times apportionment? Yes, but you look at what is remaining. So maybe your lease term was 10 years, but by the time the lease improvement was done, and you are now left with 9 years and 3 months. So you then need to divide by 9 years, 3 months, then you do the apportionment. I hope that makes sense. All right, cool, guys. Yeah, I think we can end here, guys. Thanks for your contributions. You guys have been, okay, I'm going to share the question paper for sure on the WhatsApp groups. I'm going to share the, I think I'll also share the one with the memo. I think at the right at the bottom, you will be able to see the memo as well. Okay. It takes just a few minutes to finish off the recording, but yeah, I will send you the recording as soon as possible. Let me actually stop it so that it starts processing. Okay, cool, guys. Cheers. Yeah, invite